No problem.
So what we're going to do first is ramp up your computers and start doing the research. Okay, this is a replicated trading room. We need data. There's a lot that's going on. I need to get a market update on the 5 major markets. I need to know where stock prices are. You can give me the Dow index, which is it's been around for over 100 years. I need to know oil prices per barrel. I need to know gold per ounce. I need to know where bond yields are, particularly the 10-year Treasury yield. And I need to know where the dollar is trading against the pound and the euro. So look up the stock market. And then tell me, is the stock market up or down, and give me some reasons why. And in the, first find the data. And you can go to big charts, you can go to stock charts, you can go to Thomson Reuters, you can go to Bloomberg, you can go to the Financial Times, you can go to The Economist, you can go to Wall Street Journal. On a lot of those websites, they will give you, particularly big charts and stock charts, right off the bat they're going to give you what the indexes are doing. And then usually underneath it there's articles that will tell you why the stock prices have gone up or down. So give me, where is the Dow right now? The Dow Jones Industrial Average.
Down.
What is it?
Down 10.67.
Okay, and then what's the level? I mean, what is it? Where's the actual index level right now?
20,600.
20,600. Okay, and then do you have a historical chart that basically sees, what the index has done over the last 2 or 5 years? Don't you want to have a historical perspective of the performance? Is it at its all-time high? Is it at its all-time low? Has it been trading sideways? Has it broken through a significant resistance? Do you have any interpretations?
It's looking pretty up.
It's looking pretty significant, hasn't it? Yeah, how far back did you go?
I have a year.
You have a year? Go back 5 years, since 2009, and then you'll really see how far the market has gone. This market's up over 100, maybe even 200% since the bottom when it crashed in 2008 and 9. Kind of gives you an idea of where we are, in the stock market cycle. Would this be a good time to issue shares of securities of stock when the stock market is at its all-time high? Would this be a good time to raise capital to issue stock when the stock market's at the all-time high? Or do you want to issue stock when the stock market's at the all-time low?
All-time low.
What? When?
High.
Don't you want to, if you can raise issues, if you can raise shares at a very high price,
I thought you were saying buy.
don't you get more money? No, I'm saying issuance. So would this be a good time for corporations to issue stock? Absolutely. When the stock prices are high, the cost of equity is really low. We're at an all-time high right now, and you'll probably see more companies issue more stock. Is the stock market, and what's caused the stock market to go up? You can Google it. Stock market, why stock market goes up? Why is the stock market going up?
People are buying.
Why?
Because they'll make money.
So they are buying the stock in anticipation of higher returns. Is that called making money?
Yeah.
Yeah. Okay, try and use the terminology.
Gotcha.
Okay, so they expect higher, they're expecting higher returns in the stock market, therefore they're buying stocks. Are companies going to be more, are they expecting companies to be more profitable? Yep. And if companies are going to be more profitable, you're going to buy the stock and the stock prices are going to go up. Are they anticipating interest rates to stay low?
No, the interest rates are supposed to be raised by the Fed next month.
Okay, so if the cost of capital is going up because of higher interest rates, what's causing the stock prices to go up? Because interest rates are a counter influence. If interest rates go up, in most cases, stock prices go down. So if stock prices are going up and interest rates are going up, then why are stock prices going up? Because they're expecting the revenues to grow and the earnings to grow and the cash flows to increase. So it's going to, the cash flow growth rates are compensating for the increase in the interest rates. And I'll go through the models today to give you some rudimentary models to do valuations. Okay, so where's the, where are oil prices? The barrel of oil.
$53.70.
Okay, you all should be looking up this stuff. You need to go Start looking it up, okay? I need you to start practicing and finding websites to be able to pull that information instantaneously in this clinic that we're doing. You are the traders, you're the managing directors, it's a meeting, we're trying to get an update on the markets right now so that you can go back to your desk and put together some trades. So where's a barrel of oil, what did you say?
$53.70.
Okay, is that high, is that low? What's the trend been in oil prices over the last 2 to 3 years? Is it trading sideways? Is it at an all-time high? Is it at an all-time low? We want to know all those technicals. It's starting to drop. So what was the peak? What did it peak out at recently? No. No, it's trading at $53 per barrel. What did it peak out at recently, within the last year? And then you got to go back at least 2 years. And if you go back 8 years, the price of a barrel of oil was as high as $106. And where is it now? Okay, I'm asking questions. The price of a barrel was at $100, $106 about 8 years ago. It's now at basically $50. What's the drop in percentage terms? It's like 50%. Okay, is that a lot? Yeah, it is. And where's it trading now? 53. Has it peaked yet? I think it hit like what 55 or 57 recently. Is that right? Okay, and it's dropped to 53. Can you calculate the percentage change in that between 57 and 53? Do you guys know how to calculate percentage changes? Do you know how to calculate percentage changes? Do you know how to calculate? I'm going to ask questions over and over again. Because if you don't, I'm going to have to teach you how to calculate a percentage change. Because you need to be able to calculate percentage changes if you're going to be an analyst. Okay? You can't not know how to calculate a percentage change. It's the basic skill set. Do you guys know how to calculate a percentage change? Okay. Can you calculate the percentage change or the percentage change drop from $57 to 53? Can you pull out your calculators and calculate the percentage change for me, or do it in your head? 7%? Okay, so we've had a 7% drop since the $55 peak. And we know that oil prices peaked at about 106 and dropped to around 50, and that's about a 50% drop. Okay, it's having major impact on companies, particularly oil companies and oil company stocks, and it's having a major impact on Middle East countries because they depend so much on oil. Well, if these Middle East countries and these countries were dependent on oil, now that the oil prices have dropped 50%, their tax revenues or their revenues have dropped 50%. Now they cannot service their debt, and they're not getting enough tax revenues. So they're running budget deficits. If they run out of money and they default on the bonds, that's going to have a major impact on the markets. If they can't pay their bills, then they're going to default. So it creates political and economic uncertainty in the Middle East, and oil is the #1 commodity that basically makes the world run. You didn't get here without gas, right? Most of the computers and everything that you own, you have polyester in your clothing, is made from petroleum products. So it's a huge commodity, and it basically there's geopolitical and economic consequences associated with the movement in oil prices. What about the price of gold per ounce? Where is it?
1,239.
What is it?
1,239.
Okay, yeah, I know it's been trading around 1,200. Where was it like a year ago?
It was pretty high. It was like 1,500 almost.
Was it? Okay.
It's going down.
So I know that it went up. Where did it peak at? I know it was really high in like 2008 and 9.
Like 2000. Yeah, like 2010.
Yeah, what
it
was the
like
high?
1,700.
Oh wow, okay. And now it's
50,
down to
isn't it?
around 1,200.
Yeah.
So can you calculate the percentage change between 1,700 and 1,200 for me to get kind of an idea of what the percentage drop has been? How much? 30%. 30%. Okay, is that a pretty big drop? Yeah. So the question is why? You know, why has gold prices dropped significantly, you know, over the last since its peak? Remember, gold is also an inflation hedge. People think that inflation is going to kick up and their purchasing power is going to deteriorate. They're going to go into gold. If they're scared of geopolitical risk, they're gonna go into gold. If they think that the stock market is gonna perform or yield higher returns than gold, they're gonna sell their gold and they're gonna buy stocks, okay? So gold is a precautionary asset. People go into it for fear of inflation and political fear in most cases. It's a store of wealth. People go into it when they're scared. So what you'll see is movements between the different markets. You will see people move from the stock market into gold and bonds, and you will see people, investors go from gold and bonds into the stock market, okay? Based on what they see in the marketplace and geopolitical uncertainty or certainty in the marketplace, okay? So where is the 10-year Treasury yield right now? I think you were forecasting higher interest rates, and we'll get into interest rate dynamics and interest rate determination in a little bit at the end of the lecture. So where's the 10-year Treasury? Remember, the 10-year Treasury yield is the benchmark index. It's the number one yield, on the bond, the number one index that all policymakers look at, and it's the number one yield that is used to benchmark commercial and residential mortgage interest rates. So it has a major impact. Movements in the 10-year Treasury yield have a major impact on supply and demand for mortgage capital that basically determines home prices, okay, and commercial real estate prices. So where's the 10-year Treasury yield trading right now? I think last time I looked, it was like 2.5 or something. 2.45. 2.45. Okay, so basically 2.5. Now, does everybody know what a basis point is? You know what a basis point is? When we start talking bond yields, we start talking in basis points. Okay? You know what a basis point is?
I think it was reference point.
What?
100%.
Yeah, exactly. So, you know, if the 10-year Treasury yield goes from 2.5% to 3.5%, how many basis points did the yield increase or rise? How many basis points? If it goes from 2.5% to 3.5%, how many basis points did it go up? No, not 1,000. 100. 100 basis points. So if the 10-year Treasury yield goes from 2.5% to 3%, how many basis points did it rise? Say it.
50.
50 basis points. Okay, so I'm going to be talking, when I start talking corporate yields, when I start talking interest rates, I'm going to be talking in basis point terms. Okay, so be familiar with that. Take some notes on that, because you're going to need to know that, because again, I'm going to get back to those things where I start talking, and I'm going to be talking, and you're going to go, I don't know what the hell he's talking about. Again, if you take the notes and you remember that 1 percentage point is 100 basis points, and any fraction thereof of it is going to be 50 basis points or 25 basis points, and I'm usually talking 25, 50, and 100 basis points terms. Now let's get back to the 1,000 basis points, which is really interesting, because we never talked in 1,000 basis point terms until the financial crisis. It was always in 100 and 150 basis points or 500 basis points. Now we're talking about 1,000 basis points. Well, 1,000 basis points is 100%. Or no, sorry, is 10%. And then 10,000 basis point is 100%. So you should write that down too. 1,000 basis points is 10%, and 10,000 basis points is 100%. Now, why do I say that? Because in the financial crisis, corporate bond yields spiked 1,000 basis points, which had never happened before. And then a lot of these bonds that were issued at some point had 10,000 basis points over the 10-year Treasury, which means that at 100% yield, your bonds are worthless. They're worth zero. And that had a major impact on the banking system and sent us into a financial crisis. And I'll get into the mechanisms and some of the details of the financial crisis, because now that it's happened, we all have to live with it for the rest of our lives, okay? Because things have changed. Okay, so where was the 10-year Treasury yield in Brexit? Right after Brexit, the 10-year Treasury yield bottomed. What did it bottom at?
1.3%.
What was it?
1.3%.
1.3, and it's at basically 2.5, right? So how many basis points has it gone up since Brexit?
120.
120 basis points. Is that a lot? When your cost of capital goes up 1.2 percentage points, is that a big deal? Yeah, it's a big deal. That's a big move. Okay. And then what was the lowest? Can you go back to 2008 and 9 and look at the 10-year Treasury yield and look at how low it got in the recession? So how low did it get in 2008 and 9 when we were in the deepest, darkest phases of the recession? Maybe 2008, 9, and 10 were the 4 years of the recession. So how low did it get? I think it got to like 1.3, 1.2. And remember, when interest rates go down, bond prices go up. So bond yields were at an all-time low, then that means bond prices were at an all-time high. Anybody have that historical data? Can you give me the 10-year Treasury yield in 2008 through 10? See how low it got?
2008, the lowest was 2.4.
2.4. What about 9, 10?
9, 2.5.
2.5. Are you sure? Can somebody confirm those numbers for me? I need validation verification on a lot of these numbers. It's not that I don't trust you or anything like that, but I need to have confirmation in these numbers. Because if we're trading on these things or making recommendations or forecasts, I need to have valid numbers and they need to be verified. I can't give out numbers, you know, that have not been verified. Okay, you got the chart right there.
This one? And then in
So how low did it get? So keep going to the right. Right there.
arrow.
That's it.
1.4.
Confirm that. 1.4.
1.47.
1.4. So the bottom in the yield for 1.4, and where was it after the Brexit? So go all the way to the right. How low did it get? 1.46. So basically, interest rates dropped the day after Brexit to the lowest level that interest rates got in the deepest, darkest points of the recession. Now, were we in a recession like less than a year ago? No. So why were the yields so low? That's the question. How can the yields go as low as where we were in a recession less than a year ago or a little over a year ago? How does that work? It's because of fear. People were scared. They thought there would be financial panic after the Brexit vote. They sold off their stocks and they went into bonds. Bond prices went up and interest rates bottomed at the lowest level. Would that have been a good time to refinance your commercial and your residential property? No? When interest rates are at their all-time low and your mortgage costs are at all-time lows, you're not going to refinance your property? That's crazy. Of course you are. Would you refinance some of your business loans? Absolutely. Would you issue more bonds at really low yields? Absolutely. So these market timings, based on these markets, the CFO, CEO, CIO, CTO, all those guys are looking at it, and women. They're monitoring the markets every single day. And when the yields bottom like that, boom, they call up their investment banker and they say issue $250,000 of 5-year notes right now. And they do it. And if the stock market's at an all-time high and your stock price is at an all-time high, they see it, boom, they call the investment banker, issue $250 million of Class A shares. Boom, they'll do it. Okay, so they're constantly monitoring the market, these markets, and taking advantage of them when there's advantage to be taken. What about foreign currency? Where's the US dollar trading compared to the euro and the pound? How many dollars does it take for me to buy a pound, or how many dollars does it take for me to buy a euro?
Compared to a pound to $1.24.
$1.24, okay, so where was it? Give me some trend.
It was $1.49
Okay, so it cost me $1.49.
at the end of May.
Okay, so if it cost me $1.49, right? Did the dollar depreciate or appreciate? If it cost me $1.49, it what? It depreciated, right? Because it's costing me more. Foreign currency appreciated against the dollar, and the dollar depreciated against foreign currency against the pound. So when it costs me more, our currency depreciates. When it costs me more, foreign currency appreciates. Okay? And remember, when your currency appreciates, imports are cheaper and exports are more expensive. Okay? So you want to devalue and depreciate your currency to make your exports cheaper, because net exports is a component of GDP, gross domestic product. So flooding the market with your own currency to devalue it, like the Chinese did, are trying to spur economic growth in the economy through net exports. Okay? Okay. So let's keep going. So that's it. So next time we'll do it again. It'll be a lot quicker, and I'll start asking you more questions about the dynamics and the factors that are driving those asset prices up and down in the values of the currency. Okay? We're all clear about the deliverable, right? What it is, what it's going to look like, quality, correct? Okay. And then the lectures. I will do a memo review if I have time. You all have samples of the memo, correct? Okay. In the memo, when I do the memo review, I will take you through the price forecast model. It's basically a regression model. In your brain, you're basically inputting a regression model. Okay? And in the pre-test, you want to put in, when I talk about time series, in cross-sectional regression, you want to put this model in there. Okay? You want to write this model in. So, Y hat, what's that called? Is that dependent or independent variable? What are you forecasting, the dependent or independent?
Dependent.
Dependent variable, exactly, is Y hat. And then you have the intercept, alpha, plus the beta coefficient for the first variable, the actual data, time series, regression for the first variable. You're going to add variables into the model, no more than 5. Again, I'm giving you some of the answers to the pre-test. The beta coefficient for the last variable, the actual data for the last variable, plus some kind of error term. This is your regression equation. Are you familiar with multiple regression? Did you get some of it in your statistics class?
Mhm.
Yeah, okay. You might want to go back and redo it.
And you only get 5.
I don't use more than 5. Okay, and here's the another answer to the question. If you use more than 5 variables in your model, you're probably going to get very high adjusted R squares, which is the correlation of the model variables to the dependent. Those are going to be really high, and you're going to go, woo! You know, I got a really good forecast model. But the problem is you get multicollinearity. Okay? Multicollinearity, you have variables in your model that are highly correlated to each other and correlated to the dependent variable. So you got to get rid of one of them. Okay? How do you get rid of them? I would be taking notes because this is the questions on the test. How do you get rid of it? Which one do you keep? Which one do you get rid of? This is the secret to the modeling. Which one do you keep? Which one do you get rid of? Most students would say, I would keep the variable that has the highest t statistic and is highly correlated to the dependent variable. That's the one most students would say. But the right answer is you throw out the variable and you keep the variable that has been cited the most in the literature based on theory and external validation, and external validity. Because you may be just using a random set of data that just happens to make that one variable statistically significant during that time period. But if you go over to the library and you do a peer-reviewed journal article search on how do you forecast stock prices, and you look at the variables that have been cited over the last 50 or 25 years in forecasting stock prices, you use the variables in the model that have been cited the most, and that's external validity. Okay? And I'll walk you through model building and my experience and how I built a bunch of models for my companies to be able to forecast a lot of this stuff. Okay? So that's the equation that I'm looking at. And then the articles, Seeking Alpha, the Economist, the Financial Times, New York Times, the Wall Street Journal. You're gonna need to pull up some articles, and if you go to stock charts and bigcharts.com, they have a whole series of articles underneath it. So when you're doing your research on these asset classes, in most cases, they're gonna listen to the most current articles. That will, in the articles, will tell you what are the factors that are driving these prices up and down. Okay? Then you have the economic factors in the memo, and I'm looking for 3 of them. And it's usually supply and demand, right? So if I'm building a model, I'm probably gonna have demand factors, and I'm gonna have supply factors in the model. So for oil, obviously, you know, global aggregate demand or global GDP or global industrial production is probably gonna be a variable in the model. And I'm also probably gonna have global supply, right? Supply is gonna be a negative coefficient, right? And then obviously aggregate demand is gonna be positive. So the signs are gonna be opposite, right? As more supply comes online, the price is gonna drop. As more demand and production increase, then that's gonna put upward pressure on the prices. So I'm looking for 3 economic factors, and they'll be cited in the article. And then the derivative trades, I will go over the sets of derivative trades. There's only 2 sets, so you just need to memorize them, and then I'll do a lecture on derivatives. Because when prices go up and when prices go down. So I'll set the 2 sets, and that's it. Don't deviate from them. That's it. Okay? So it's pretty binary. And then the bullet points in the memo, you're gonna have to conduct analysis and talk about the index or the price levels and be able to calculate the percentage changes. Be an analyst. Give me the data. I memorize all this stuff when I'm reading those memos. So a lot of the information that you're writing about in the analysis, I use in my conversations with clients and other people within the firm. Okay, because that's what those are. They're trading briefs. Okay, so you're providing us with the information that we can use to communicate to other people what's happening in the marketplaces. And then the graphs, try to get the graphs from the same source. And then the biggest challenge for you as students is getting the graphs to align, you know, perfectly so they look like brother and brother and sister and sister and sister and brother, so that they look like little graphs. Not one's all bigger than the other one and the other one's like really small, or, you know, one's, it's in the margin, or, you know, they gotta look really good. So those memos that I gave you, the students worked really hard to get those graphs to look perfect so that they align with the text. So I can read the text and I can go right over to the graph and I can see the analysis from the graphs, and I can also pull out a pen and start doing technical analysis on the charts. So the memos are really, really powerful communication instruments. There's a lot going on in just that one page. Okay? So I'll spend more time on the memos, but that's basically it, high level. The lectures, you know, I'll try to move pretty quickly through these because I want to get to that lecture over there. The book is great, but the meat and potatoes are over there. Okay, so I want to get there as quickly as possible and start teaching you the really the value add concepts that you're going to use on a daily basis going forward. And we're going to talk about yield curve dynamics. Yield curves are basically the interest rate on U.S. government treasury securities by maturity. Okay, all debt, all bonds, all stocks, all real estate, all derivatives, all currencies are priced off of the yield curve. Okay, and the book mentions the yield curve once in like a little something, and that's it. Okay, we got to go through the macroeconomics of yield curve dynamics and the monetary policies that surround it. And then I'll show you how important it is. Once you get the fundamentals of yield curves and yield curve theory, it becomes the basis for the book to do all the valuations. So by just learning the finance book and not understanding the yield curve dynamics and determinations of interest rates and asset prices, there's a big gap. And that's all you're doing is just working problems. And that's useless, in my view. You got to have a more organic view of everything to really then know why you're doing those problems and understanding the impact on those problems if the dynamics start to change. So we'll talk about yield curve dynamics, and I'll show you how important it is. We'll go through interest rate determination, how interest rates are determined, how the yield curves are determined, and what the theory is behind that. Obviously, interest rates are the risk-free rate, okay? The yield curve is the risk-free rate. The interest rate is the risk-free rate. The risk-free rate is the basis, the base rate to determine all cost of capital. Debt capital, cost of debt, cost of equity, and also expected returns. So if I'm an investor investing in the stock and bond, I'm investing in it based on some expected return. The investor's expected return is the company's cost of capital. Same equations, but different view. I'm looking at the equations as a business raising capital, and I want to minimize my costs, or I'm an investor providing capital to the company by buying their stocks and bonds. I have an expected return. The marriage between the two determines the expected return and the cost of capital. Okay? So once you determine the cost of capital and the expected returns, you can calculate the asset prices and the intrinsic values of the stocks and the bonds. And you can do the same thing with real estate. And you can do the same thing with derivatives. Then once you determine the prices and you know what the price and the intrinsic values are, you're basically going to probably start buying and selling securities. Start buying and selling stocks and bonds in most cases. Or trading the securities, trading the derivatives, trading the real estate, trading the stocks, trading the bonds. Once you start trading them, you're probably going to come up with a portfolio strategy because you're not just trading one asset, one company, you're managing a portfolio of company stock, a portfolio of company bonds, a portfolio of real estate assets, and a portfolio of derivative securities. Okay, so then you move to the portfolio level, and there's a whole range of theories around that I'll teach you. And then the other is, from the firm standpoint, how do we invest? How do we make investment decisions? What are the criteria, what are the models that we use to crank through that data to get the results, to be able to say, yes, we should buy that stock, or yes, we should buy that bond, or yes, we should buy that company. So I'll take you through all the investment decision theory, and I'll take you through all the logic and train you to think that way. Any questions on that? That was kind of a high level, just summary and an overview. Is there anything really quickly that you want to get out of this class specifically, so I can tailor it a little bit too and focus it? I can teach you everything that I know, but is there specific things that you want to learn so I can integrate it into the lecture and make it more value add? Venture capital, underwriting, investment banking, securities analysis, valuation, accounting, balance sheet, income statement, financial ratio analysis, how to buy real estate, how to buy stocks, how to buy bonds. No? No interest? Go for it.
For me, I guess more of how to buy stocks.
Okay, I'll train you on that. Okay, the class has a lot of that. Okay, so you'll be doing a lot of the mathematics, and then we're going to do 2 presentations at the end of the semester, and by the end you'll be an expert. Okay.
Why not the accounting side of things?
Okay. So we'll go through capital structure, asset liability management, liability structuring, capital stack, and how to minimize the weighted average cost of capital. Okay, so I'll walk you through that stuff. I'm not going to get too much into the detail because it's the finance side, but you're an accounting major. You're really going to get into it probably in your intermediate. And don't you take 2 semesters of intermediate?
I'm already through that and advanced accounting, so
okay. Okay, cool.
So.
Okay, so I can maybe we work together on getting where we can do more advanced capital structure.
Yeah.
But I'll walk you through a lot of the theory and stuff like that. Okay, anybody else? Go for it.
Real estate market?
Okay, what I will do also is in the class for the midterm and the final. The in-class will be smaller, but I'll have a real estate example where we're basically the investment bank and we work with a real estate investment trust, Alexandria, out of DC, but they have Mission Bay in San Francisco. We'll do $1 billion real estate transaction, and I'll walk you through that acquisition and development. Okay? And then we can talk more about that too, okay, if you're interested in getting licensing. Anybody else? Have any specifics that they want to focus on? Okay, next class, if you have any, just tell me at the beginning of the class, okay? 'Cause I want to customize this thing. Okay, so let's kind of go through the first couple chapters really quick. So the overall financial goal of the corporation, publicly traded corporation, could be private, but we'll focus on publicly traded companies as share maximization, share value maximization. How do you manage the company? How do you manage the assets and the liabilities? How do you acquire assets? How do you manage the liabilities to maximize the share value? Period. That's it. Everything flows from that. So if I wanted to build a model, how do you maximize shareholder value? Well, you're going to build a model and you're going to have factors in the model. Okay, what are those factors? Well, you got to minimize the risk to the firm. You can't over leverage the firms. You can't issue a ton of bonds to lever up the firm to juice the return on equity for the shareholders, because at some point in time you're going to be over levered. You're going to have too much bonds. And remember that the bonds have the first claim on the earnings, not the shareholders, but the bondholders. They have the first claim. So if you have a ton of bonds on your balance sheet, you're paying out a lot of interest to the bondholders. And when the economy goes in the crapper, you're not going to have enough earnings to service the bonds. And if you don't have enough earnings to service the bond interest, you're going to default on the bonds. And the prices are going to collapse, the cost of capital is going to go up, and your share price is going to collapse, and you're going to get fired. Okay? Because you over-levered the firm. And you expose the firm to bankruptcy and credit default risk. And I'll walk through credit default economics and credit default spreads, and I'll teach you how to determine and come up with the cost of debt for a corporate bond. Prudent asset liability management. You got to match the duration and the maturity of your liabilities with your assets. You can't mismatch. You can't raise long-term capital to fund inventory. You raise long-term capital to buy plant and equipment, to buy plant. Physical assets, they're going to last 30 years. You issue medium-term bonds to buy equipment, and you match the 5-year bond with the 5-year life of the equipment, because you can depreciate it in 5 years under GAAP. And then you issue short-term liabilities to finance your inventory, short-term liabilities to finance short-term assets, medium-term liabilities to finance medium-term assets, long-term liabilities to finance long-term assets. If you can match the duration and maturity between your assets and your liabilities, you're prudently managing the balance sheet. It's when you start mismatching it that you run into problems. And companies I've seen run into problems. You need to be able to take advantage of investment opportunities that are presented to you. We got an opportunity to buy a company, it's got intellectual property, it's got distribution channels, it's got good employees, it's got good products that are coming out, it's got a good brand, we should buy it. Or we should build a new plant. We should build new equipment. We should basically do an advertising campaign or a marketing campaign. So there's investment opportunities that may be presented to us that we need to be able to know that our liabilities and liquidity is available so we can take advantage of those opportunities. Either we're going to develop it or we're going to buy it. It's buy or build. Okay? So you got to be able to make those decisions. So you got to take advantage of investment opportunities, and you got to take advantage of the marketplace, particularly the stock and the bond market. When the prices are really high, boom, you issue stock and bond to lower your cost of capital. Because at the end of the day, the goal is I'm going to get some kind of internal rate of return on my assets. And I'm going to subtract out some weighted average cost of capital, this is my margin, and I'm going to get some kind of spread. This is capitalism right here. I basically raise the money, I buy the investment, the return is higher than the cost of the capital that I'm using to buy the investment. I'm going to generate a positive spread. And if the spread is wide enough, and I can do it consistently over time, I'm going to profit maximization, and my share price is going to be at its all-time high. Yes?
I'm just making sure I heard you right. So you said when prices are high, issue bonds to lower your stock and capital?
Yeah, when stock and bond prices are high, your cost of debt and equity is low. So there's an inverse relationship. As the prices go up, your cost of capital goes down. So you want to issue the stocks and the bonds when the price is at their all-time high and lock in your cost of capital. And if you can invest wisely in projects that are profitable, you win. That's the name of the game. So the ability of management to basically make investment decisions, sound investment decisions, and the ability of management to manage their liabilities and generate a spread consistently over time that's wide enough that they will be around forever. Just look at New York Life. It's been around 167 years. Been doing this for 167 years. Is that a long time to be in business? Yeah.
Just really quick to reiterate, so the WACC is my capital, correct?
That's called the weighted average cost of capital. I will get into that, okay? And I will get into the internal rate of return.
Right.
But I'm just giving you the equation now, so you understand what I was trying to get at here, okay? The other is access to the capital markets. If I have securities that are already being traded in the stock market and bonds that are already traded in the bond market, I can access those markets very quickly when the prices are really high and my cost of capital is really low. I can call the investment banker, boom, get the issue, raise a $500 million in capital within 24 hours. Or more and less, depending on if we have been around a long time and we have enough liquidity in our issues in the marketplace currently. So it creates liquidity when you have shares out there. Also bank financing, having really good relationships with your banks to be able to use institutional capital, to not have to go to the markets, but maybe at some point in time in the cycle, it's cheaper to borrow from the bank than it is to issue stocks or bonds. So you have that relationship too. So banks are a permanent component of borrowing for most corporations, for all businesses. You also need ethical behavior, okay? Although some of these financial institutions and some of these companies have had episodes of lack of ethical behavior, in some cases it has tarnished the brand permanently, in others it's been temporary. So just look at Wells Fargo. That basically manufactured 2 million fraudulent accounts. John Stump, who is the CEO of the company, fired. Okay? They haven't recovered yet from it, and we'll see if they ever do. It's still a really good brand. But unethical behavior on the part of senior management or lower level employees could have a permanent damaging effect on the company, which is going to hit their brand at the end of the day. You also need employee stakeholder loyalty. People got to want to work there, got to want to buy the product. Got to, when they buy that brand, they basically associate that brand with their own internal brand. So you have to have employee stakeholder loyalty, you got to have stockholder loyalty, and you got to have customer loyalty, which is going to produce the product demand and provide the liquidity for the shares, the stocks and bonds. So it's all related. You need brand loyalty. You got to come up with new product development, and you got to innovate. Just look at Nike and Adidas and Apple. I mean, they're constantly producing new products, and they're constantly innovating. And I'll go through product innovation in a little bit more detail from the financial services industry. I'll basically replicate what you've learned in your marketing classes, but I won't be using tennis shoes, or cell phones. I'll be using financial products, financial instruments, and show you how innovative, how brilliant a lot of these companies are in how they develop these new financial products and bring them to market very, very quickly. Generate consistent cash flow growth rates. That's the goal to stock price maximization. Can you continue to grow your cash flows at a constant rate forever? And I'll show you the valuation model associated with that assumption. And if you look at IBM, and you look at HP, and you look at Cisco, and you look at Salesforce, and you look at a lot of those companies, their stock price reflects constant cash flow growth rates forever. Okay, forever. Generate consistent cash flows. Cash flows could be dividends paid to the shareholders who own the stock. They could be earnings per share. So the total amount of earnings divided by the shares outstanding is gonna be your earnings per share. This is the number one metric used to value stock, okay? It could also be earnings before interest and taxes, EBIT. For those of you who are getting into startup companies and small, high growth companies, you're gonna be valuing the shares using probably EBIT or EBITDA, earnings before interest, taxes, and then you add back depreciation and amortization, okay? EBITDA, EBIT, EBITDA per share. EBITDA per share is what you're gonna use to get the valuation of the shares. And if you have the value of the shares and you know the number of shares, you can multiply the two and get the value of the company's equity. So a lot of these techniques and methodologies can be used for valuing bonds, stocks, companies, assets. A lot of the methodologies are recycled. So once you learn the basics, you can apply them to multiple scenarios. Working capital management, you gotta have enough liquidity on hand to basically be able to run the business. And if you get liquidity shortages, you better have a good relationship with the bank to get access to liquidity. Credit line. A credit line with probably multiple banks. So if you have cash shortfalls, you can access the bank, and the bank will provide you with the liquidity to keep your operations going. Asset liability, maturity and duration matching, we already talked about that. Benchmarking is extremely important, and we'll be doing financial ratio analysis and benchmarking later in the class, but you'll start getting some exposure within the chapters on some of the key financial ratios that you would use to benchmark the firm's performance, and then take those GAAP accounting produced financial ratios and compare your firm's ratios with the direct competitor or competitors, the peer group, and the industry. And if your financial ratios outperform the direct competitor, the peer, and the industry, your overall financial condition and position is good and could be excellent. If not, if you fall below the financial ratio benchmarks, then you will get a poor rating, and the overall fundamentals of your firm, the overall financial condition and position is poor, and that's going to be reflected in your stock and bond prices, in your ability to raise capital, in your cost of capital. You'll be impaired. But the firms that we're looking at, the Goldman Sachs and JP Morgan are the top 5. Their financial ratios are pretty good. They should be, right? If you're the top 5, you're the one of the top 5 for a reason. You need clear forward-looking guidance, okay? Clear forward-looking communication. This is where your marketing departments and your communication departments really come in. They basically take the financial and operating ratios and performance of the company, and they craft it into very precise communications to the media, to investors, to employees, and other stakeholders around the company. So really critical to the market, to the company, and the financials. You need transparency into the financial condition of the firm. I need to know the income statement and the balance sheet, the cap accounting rules, and that the balance sheet and the income statement, along with the financial ratios, truly reflect the underlying condition of the firm. It's transparent. If I don't have transparency in the accounting, then I'm getting misinformation, and it's really hard for me to basically buy the shares or the bonds of the company. And it's going to be harder for me to basically raise capital if I'm not transparent. And there's a whole, the accounting measures, as you know, there's a whole science, around reporting and how to guide and how to report. A lot of these banks ran a lot of losses in 2008, 9, and 10, and carried those losses over and smoothed out a lot of the losses, but a lot of them actually took the losses, reported the losses, ripped off the Band-Aid, and then showed consistent earnings per share growth rates afterwards. They just said, screw it, we're not going to spread it out, we're going to take the hit, we're going to report it, take the hit to the stock price so we can recover quicker. Okay. And then the calls. The analyst conference calls, if you go up to any publicly traded company of a certain size, they have quarterly analyst conference calls. And on those the investor relations portions of the website. They will have the 10K report, and they will have the audio of the conference calls. If you're totally interested in this stuff, go listen to the analyst conference calls. Because all the language they use is all the language that you're learning in your business degree and in finance and accounting. Okay? So the calls are really important to communicate to the investors, both retail investors and institutional investors. Retail investors are small investors, institutional investors are pension funds and endowments, very large institutions with huge holdings in these publicly traded companies if they meet the criteria for investment. Valuation of the firm, it really depends also on the structure. How do you structure your company? People ask me all the time, Professor Souza, how should I structure my company? Well, don't structure it as a sole proprietor first. Well, I'm a small business, blah, blah, blah. It's like, okay. So you're generating all this revenue, you get all these deductions on your personal income tax, but what happens if somebody gets shot, at your building and gets killed? Or somebody trips down some stairs and gets maimed, you're gonna get sued. When you get sued, they're gonna take everything. They're gonna take your house, they're gonna take all of your pensions, they're gonna take everything from you, because in a sole proprietorship, you have unlimited liability. So people do it just because it's easy, but I'm saying don't do it. You'll get slaughtered. If you have exposures, you have exposures. So usually unsophisticated business people use sole proprietorships. There are partnerships, limited partnerships, professional limited liability companies for CPAs and attorneys, and then there's limited liability corporations, the LLCs. A lot of people, and I hear it all the time from attorneys and accountants, they say, just set up an LLC. Okay, well, the LLC is great because it's a pass-through entity. I make the revenue, I deduct the expenses, boom, the money flows through, comes to me as personal income, and then I pay the taxes and income tax. Love it. So they're really cheap to set up, they're easy to set up. So most people are limited liability corporations, and by setting that up and running everything through it, you create a veil that protects your personal assets if you ever get sick. Okay? So this is probably the most popular corporate structure. Okay? And then there are the S corporations and the C corporations. Okay? And most publicly traded companies, really all publicly traded companies, are C corporations. So my view is, if you're going to do it right the first time. A lot of people will set up their corporations as S corps, which are like partnerships. They have protections, they have pass-throughs. So they're like a hybrid between the LLC and the C, kind of like somewhere in between. I'm saying if you really think that your growth prospects are going to be really good for your company, and you're going to hire employees at some point, and you're going to issue shares, and you may sell the company at some point in time through a purchase of the stock in your company, go ahead and set up the C corporation first. Huge benefits. It costs more, and you have to have corporate governance, and you got to have the minutes, and you got to do all these things. And it's more expensive from an accounting standpoint to set it up, but there's all kinds of benefits and expenses and medical deductions and grants and all kinds of stuff that you can do in a C that you can't do in an S. And then at some point in time, it's like, oh shit, I really need to become a C corporation. Well, the attorneys and the accountants are going to hose you when you try to convert from an S corporation to a C corp. Okay. So I say go ahead, do the C, and take all the benefits and learn how to run a publicly traded company or a private company. That's why I did it. Okay. So I've set up multiple C corps. I've set up an S. I've set up LLCs for myself. I got rid of this. I got rid of that, and I kept this. Okay. And then later on, as a C corp, you have access to capital. So you can issue shares, raise capital, issue bonds, raise capital. It just becomes easier. So, but again, it's a little bit more complex. Organizational structure and design of the company, hugely important. When you put together your business plan, what's the structure of the company? Is it by functional line, or is it by divisional or product line? Does the organizational structure of the company match the external environment? This is kind of a weird structure. It's not your typical org structure, but you have basically the C's, president, CEO, CFO, COO, CIO, CTO. You got your functional or product line divisions that's usually down here, and the C's are up here. And then you basically have your staff and your admin. A lot of companies are set up by function, so legal, accounting, operations, finance, accounting, capital markets, development. So you have those functional lines. And then if you look at the large conglomerates, they're basically set up by product line, divisional line. So if you could look at HP, the printers is a big division. You got global consulting is a big division. You got software is another, hardware is another. So they're usually by divisional lines. They could be by geography. So you might have, North American operations, and underneath North American operations, you have the divisional lines or functional lines. Divisional lines depends on how you structure the company, depending on what industry you're in and what markets you're in. And then you calibrate the organizational structure of the firm to basically maximize the cash flows and minimize the risks and the cost of capital. So you hear a lot of times how companies are restructuring their organization. They have to restructure because it's become myopic and dysfunctional. So they need to restructure the company to better match the external environment. Go for it.
What's BOD?
Board of directors. So the board of directors basically is the ethics and the corporate governance of the company. Unfortunately, you usually have a conflict of interest where the CEO is also the chairman of the board. That's a conflict of interest. And usually the CEO becomes the chair and picks the board of directors. So they're basically yes men and women, basically advocating on the CEO's behalf. Okay, so there's no real critical confrontation or feedback on policy.
Does that say government? What's under stockholders?
Stockholders, stakeholders, stockholders, and government. Because these may be regulatory arms. In financial institutions, we have compliance, so we're highly regulated. So we deal with the government constantly through regulatory oversight. Okay. So you want to avoid agency conflicts. Are you making decisions in the best interest of the shareholders, or are you making decisions in the best interest of yourself? Okay. Is the senior level manager making the best decisions for their own benefit or the benefit of their shareholders? That's where you're going to get agency conflicts. Okay. And the worst scenario is you have ethics violations. Okay. Should you have been talking to the Russians, about the embargoes, leading up to the election? Probably not. Ethics violations gone. Okay. And some organizations have zero tolerance. Okay. And you'll be confronted with these, and I'll get into the ethics as we move through. Later in the class, I'll have whole sections on ethics and morality, particularly in financial services. But you will definitely, at some point, probably be confronted with an ethical decision that will basically jeopardize your position. And then you have to decide. Do I basically allow it to happen and violate the ethics and probably get fired later as they find out about the ethics violations about the other guys? When they get rid of them, they're going to get rid of you. Or do you say something about it and bring it up and then get fired? Or you become a whistleblower and may keep your job, but most of those guys don't last. I've been fired a couple times, okay, through observing unethical behavior in the company, and then basically bringing it to the board, and then I got fired. Okay, what changes the org structures? It's usually the changes in the environmental factors, global, market factors change, regulatory changes is really, really, really big. Or some kind of shock, like a financial crisis or an economic collapse of some sort, or political collapse within the broader society. You need to then very quickly redesign the company organizationally and realign it based on an environmental scan that you need to conduct of the market and the competition. Because when you want to design the company organizationally, you want to create a comparative advantage over your competition so you can gain market share and capture those cash flows and those revenues and grow it over time to maximize the stock price. You gotta align with regulations and market dynamics. Sarbanes-Oxley and Dodd-Frank was huge for financial institutions in their organizational realignment around the regulations. Maximize the shareholder wealth is really what it's supposed to do. The ability to sell into the market efficiently, particularly the securities, will be one of the benefits. And then again, to generate additional cash flow growth rates. It's really the objective associated with organizational realignment and restructuring. When you go on to study for your MBA, or maybe you do a master's in organizational behavior, a master's in management, you'll really get into a lot of this stuff strategically. And that's kind of where you want to be. Let's talk about factors affecting stock prices. There's basically 4 models that you're going to burn into your brain and memorize. And we're going to go over and over and over and over again. Okay? The first model, this is cash flow, CFO T+1 divided by IE. This is basically the cash flow. Could be dividends, earnings per share, EBITDA per share next year. So you're always forecasting that one more year when you're doing the valuation.
Do you want us to turn to this?
Pardon me?
So what's the term?
Yes, please. Thank you. Thanks a lot. Appreciate it. And then if somebody can give me a time check, like when I have 40 minutes and 20 minutes and 10 minutes, then that way I can pace myself. How much time do we have? How much? 30? Okay,
Yeah,
so,
level, you're right.
okay, so I'll keep going. See if I can get through the rest of this. So this is the first valuation method. Next year's cash flow, again, it could be dividends, earnings per share, EBITDA per share, free cash, whatever it is. Next year. Okay? Divided by your expected return, okay? Or your cost of capital, depending on what you're valuing. So this is also called the discount rate. The discount rate. Okay? Cash flow divided by discount rate. It's going to give you the value. So if interest rates or expected returns in the market go up, the valuations go down. Cash flows go up, holding the interest rate or the cost of capital constant, then the valuations go up. That's just a basic, simple perpetuity model. So you need to memorize that. If that goes up, that goes down. If that goes down, that goes up. That goes up, that goes up, that goes down, that goes down. You gotta run that through your brain. Because all the traders, all the CEOs, all the CFOs have these equations basically embedded in their brain, and they work through the information and use these models to do the valuations, okay, on everything. The second model, and this, remember, assumes this perpetuity model. And it assumes that these cash flows are going to remain constant forever into infinity. Into infinity. So the mathematics, the calculus, basically comes down to a proof. The proof is basically cash flow divided by the discount rate gives you the value. So I would play with that and then memorize it. So this is a bond, and this is the coupon on the bond, and this is the interest rate on the bond. If interest rates go up, bond prices go down. If interest rates go down, bond prices go up. You gotta memorize that, okay? You cannot be in an elevator with Chuck Schwab or somebody from E&Y, and then it's like, whoa, can you believe that the 10-year treasury yield went up 50 basis points today and bond prices went up? Get out, stop the elevator, open it up, go have lunch. I'm gonna go upstairs and talk to my clients. So you gotta know the logic, okay? So the next model is the Gordon growth model. And Gordon growth basically states that the cash flow is going to grow at a constant rate forever. Here, the cash flow is going to remain flat. Here, it's going to grow at a constant rate forever. So your discount rate or your expected rate of return minus the growth rate is going to be the denominator that you use to divide the cash flow by to get the valuation. So if the growth rate expectation goes up, then the valuations go up. Growth rate expectations go down, the valuations go down. These are expectations and growth rates. So if that goes up, this goes down, that goes down, that goes up, that goes up, that goes up, that goes down, that goes down. So you play with the logic. It's a game, right? Accounting, finance, ops, marketing, you're all learning models. Basically, this is all a game, right? You learn the rules of the game, and you become successful. You don't like the game, then that's unfortunate, because you'll have impediments to your success. You have to adopt. The second model is called the multiple approach. Multiple approach. And it basically states you take cash flow for next year and multiply by a multiple, some kind of X factor, to get the value of the share. And the multiple is usually the price of the share divided by the earnings per share. For the multiple, or the PE multiple. And I'll get into other types of multiple manufacturing a little bit later. But it basically states that if the multiple increases, the value of the share increases. If the multiple goes down, the value of the share goes down. If the multiple goes up, then that means that the market is expecting higher growth rates in the cash flow. So they're giving them a higher multiple. So very high growth, cash flowing companies have high multiples. Companies that have low cash flow growth rates have low multiples. And then the last model is the discounted cash flow. Or what is called DCF. And you'll be, as you're working through the homeworks and you're working through the exam, you're going to be practicing future value calculations, present value calculations, and you're going to get really good at present value, future value calculations, growing cash flows, discounting them, growing them, discounting, so it becomes just second nature for you. And the discounted cash flow is probably the most important of the skills that you will learn in this course. Because you will build pro forma projected income statements, and then take those income statements and discounted cash flows back for investment decision-making, valuation, investment banking, securities analysis, acquisitions, mergers and acquisitions. So the discounted cash flow is really, really important. And it basically states that you're going to have these cash flows going out over a time period, a holding period. Let's say it's 5 years. So I'm going to grow these cash flows out over 5 years. And then I'm going to discount those cash flows back based on these discount factors. So if this is the first year, it's 1.1 to the 1 if it's a 10% discount rate. Year 2, it's going to be 1.1 squared. And then you go all the way out to year 5. So you have to know how to do the exponential calculations to get the discount factor. And then you add, this is a 5-year holding period, 1.1 to the 5th. Let's say this is the last year, 1.1 to the 5th. In the very last year of the holding period, you're going to get the last year's cash flow, and you're going to get the terminal value of the asset. The terminal value is basically just the cash flows that you would have gotten past the holding period brought forward. And then you discount that back, holding period year, that back by the holding period, bring it all forward to get the present value. Get the present value of the cash flows. If you deal with the cost of the development, the cost of the acquisition of the firm, the cost of the share price, whatever it is, you subtract it, you get the net present value. If it's positive, you buy it. If it's negative, you reject it. And we'll go through the investment decision making. We'll get really into this stuff, because this is the most important. How am I doing on time?
20.
Okay. The overall financial system. Okay. So a lot of this is the mechanics that we're using, but again, to be able to value the securities, the shares, and the businesses at some point in time, we're going to have to go access the capital markets, and the capital markets performance and health is basically determined by macro global factors. Oh yeah, let me go back. So what are the factors that affect stock prices? War. So if war happens, this goes up, this goes down. Financial crisis, this goes up, that goes down. Natural disasters, this goes up, that goes down, or it impairs your cash flows. And that goes down. Laws could benefit you. Basically, a deregulation under Dodd-Frank is going to benefit financial institutions. Cash flows go up, the value goes up. Or new regulations and laws come in that restrict your ability to grow the cash flows, that's going to cause that to go down and the value to go down. Taxes go up, cash flows go down, the values go down. Regulation, we talked about that. Fiscal policy is taxation. Regulation is Sarbanes and Dodd-Frank. Dodd-Frank and Sarbanes added another level of accounting costs to the firms, which hit their earnings per share and hit their stock prices.
So would people be going away from buying stock in retailers at the moment?
Say that again?
Would people be going away from buying stock in retailers in the moment?
Due to online competition, one has major impact. I mean, Macy's is gone, right? Downtown San Francisco, it's hurting Macy's, right? Amazon's hurting Macy's. So competition could hurt retailers. Is that your question?
Well, I think also, would it be a smart decision to go away from buying in retailers because their expected profits are going down because of
That's right.
Mexico?
That's right. Yeah, so when you hear about repealing NAFTA, the question, who's gonna get hurt and who's gonna benefit? Well, the auto industry is gonna get hurt because they manufacture the majority of the products overseas. And then importers, Walgreens and Walmart are gonna get hurt because they manufacture the majority of the products overseas. And if you tack on an import tax, that's gonna hit their profits and it's gonna hit their stock price. Exporters are gonna benefit, importers are gonna get hurt. People are doing the whole policy analysis now, and when you're seeing the stock prices start to adjust based on those anticipated policy outcomes. Okay. The business cycle. Stocks and bond prices are highly correlated to the overall business cycle measured by gross domestic product or GDP, industrial production, inflation, employment, wages. Those are all economic indicators that track the business cycle. Global capital markets. Again, if stock and bond prices are really high globally, we can issue a bunch of shares, drive down the cost of capital, and drive up the value. If all of a sudden there's a financial crisis, or a stock market collapse, or a bond market collapse, that's going to have a major impact on the cost of capital. It's going to have a negative effect on the valuations. Monetary policy. If interest rates go up, the discount rate goes up, and the value goes down. If interest rates go down, the cost of capital goes down, and the values go up. Consumer confidence in business. Consumers and businesses are consuming and investing. That's positive. That's going to cause the cash flows to go up and the values to go up. And at the firm level, what is the line of business and industry and who are the consumers that the company is in? Do they do a good job of managing the balance sheet? Do they produce quality products at low costs and basically price the product correctly to generate revenue and market share? Do they have effective marketing and sales? Do they have research and development, bringing out new products and providing those to their clients once they're locked in? And then timing and magnitude of the cash flows. Do we already have very high cash flows and revenues that are growing at a constant rate? Or are we a startup company where the revenues and the cash flows are growing at an exponential rate but at a very low level? So ideally you want large cash flows that are growing at a rapid rate. But again, as your company gets bigger, it's hard to grow the revenues at a very rapid rate. So smaller companies will grow faster, and their multiples are going to be higher, and their valuations are going to be higher in anticipation of rapid revenue growth or cash flow growth. Capital markets, there's basically two markets. There's the financial institutional market, and then there's the capital markets. These are the instruments that are being traded in the marketplace where companies have accessed the markets to raise capital. So they can issue stocks, they can issue bonds, they can package mortgages and issue mortgage-backed securities. derivative contracts, which I'll get into a lot of detail here, because that's really where the product innovation has come from in the finance field, and how do you use these derivatives to hedge or take advantage of market changes or movements. Real estate is part of the capital market. Private equity or public equity, private and public debt. And then insurance products, life insurance products and annuities are also part of the capital markets. Financial institutions, you have banks and investment banks that are large participants in the marketplaces, not only making market in these instruments, but also creating new products and bringing them to the marketplace to satisfy needs. And I'll go through a whole lecture on financial product innovation. Because that's one of the areas that I was heavily involved in, was bringing new products to the marketplace, financial products. Shadow banks or hedge funds have emerged since the financial crisis as a major intermediary between investors and then investing money, raising the capital, investing it, based on trading techniques. Insurance companies, particularly mutual insurance companies, take basically savings and deploy that capital into bonds and then back the life insurance products and the annuity products. And then mortgage companies and credit unions are also intermediaries in the marketplace that channel capital from savers to investors. The system is basically a circular flow. You have the capital markets here, which are basically the publicly traded securities, and then you have the financial institutions. So you have people that are borrowing, businesses will borrow, and consumers will line up credit, consume, to maintain their standards of living. Obviously governments will borrow to spend. And then you have the lenders, the savers, people who are lending the capital, and people who are saving. So the savers get the money, put them into the market or the financial institutions, and then the institutions, the markets redistribute the capital to the people who are borrowing it and need to deploy it. So this system, it actually works really well. This is capitalism, this is financial intermediation. That works, but this breaks down during financial crises. And you see stock and bond market collapses sometimes when this circular flow shuts down. And I'll get into that when I talk about the financial crises. There are two markets. There's the primary market. These are new issuance of the securities. So new stock issuance, new bond issuance, initial public offerings. Startup companies that are looking to access the capital markets and go public. There's a secondary market, which are existing firms that already have shares traded, bonds traded in the market, and they're just issuing more to raise capital to then deploy into the company. You have money markets, which are instruments that with a maturity of less than 1 year. So they're short term, they're revolving. So they're very short term instruments. That's called the money market, it's less than 1 year. And then the capital market, which includes bonds, long-term bonds, with maturities greater than 1 year. Stocks are part of the capital market, and real estate's part of the capital market. So these are long-term capital market assets, or securities. The goal is liquidity. Can I get instant pricing? We want to do a stock issuance. What price can we issue that stock at, and what's the cost of capital going to be? Well, if we already have securities that are highly traded in the marketplace and there's a lot of liquidity, then the shares are fully priced continuously. I can just go look at the ticker symbol and look at where the share price is trading because it's highly liquid. Can these shares be bought and sold easily? Or is it hard to buy and sell? So that's going to be the marketability of the securities. And then efficiency. Can I call the investment bank? Can I call my broker and buy and sell these securities in really large blocks of shares or bonds in a timely fashion, very quickly, and at a minimum cost? There are what are called market makers in the market. Banks are big market makers in currency and bonds and stocks and derivatives, along with the investment banks. A lot of these securities are traded on exchanges. New York Stock Exchange, NYSE, is the big board. It's the highest profile at the company, exchange. There are exchanges all over the world, stock exchanges all over the world. And then the other one, the National Association of Security Dealers, the NASDAQ exchange, is where the majority of small companies go to list their securities and issue first. And then usually what they'll do is they'll start on the NASDAQ and then they'll migrate to the big board once the company becomes big enough and meets the criteria to be listed on the New York Stock Exchange. Okay. Then there are broker-dealers. The broker is just the intermediary between the buyer and seller. So I just make a fee, basically, or some kind of spread between the bid and the ask. Okay. The bid is what I'm bidding, the ask is what it actually transacts. And then the dealers actually hold an inventory of these stocks in inventory, and they basically manage the price. If it gets too high, they sell. If it gets too low, they buy. So they're basically a market maker, okay, in the security. The over-the-counter market is the private market. Public market, exchanges, private market, over-the-counter, or OTC. A lot of derivatives are traded OTC. A lot of derivatives are traded on the exchanges. Some of the shares are traded over the counter. Some of the shares are traded on the exchange. Okay. If they're traded over the counter, I don't know what the transaction was. If it trades on the exchange, I got the recordation of the transaction. So the movement from OTC to exchanges was part of that. Trying to get transparency on a lot of these derivative trades so that we have clarity in what the exposures are to the system based on the trading of those contracts. And then market efficiency, or violations of efficiency. The assumption is that the stock market and the bond market are highly efficient, okay, both operationally and based on information. So publicly traded companies do the 10Ks and the annual reports. There's a lot of analysts that are tracking these publicly traded companies. A lot of people are doing research on these companies. So a lot of information is coming to the marketplace on these companies that then gives you the information you need to price them. Okay. There are basically three forms of market efficiency: strong, semi-strong, and weak. I'll start with the weak. The weak form basically states that I can look at a chart, stock price chart, and go back in time and know that all information available on that stock, historically, all the historical data is embedded in the current stock price. So I can't use technical analysis to basically be able to trade the stock. I can't look at the patterns of the pricing and be able to say, oh, it looks like the stock broke through here and it's going to probably continue to go up. The weak form says you can't make money doing it. However, the technical traders use technical analysis and have proven that there's a violation in the weak form because they make money off trading off the patterns of the prices. So the assumption is that this is the market, but there's also violations in it. And there could be violations at certain times, or for certain types of stocks. Semi-strong basically says that all public information, reported information, along with the historical price data, is already reflected in the press. So if a news release or a 10K report comes out, once the earnings report comes out and the financials come out, stock price is going to adjust instantaneously. So there's no way of really making any money unless you have insider information as the auditor that was putting together the financial information. And even the strong form says that even historical patterns, along with all publicly available information, along with insider information, you still can't make money because all that information is already embedded in the stock price. But we all know that if you have privy to insider information, you can trade on that stock, but it's illegal. You'll probably get thrown in jail if you have to. assumption is even all that information starts to leak out, leading up to the press release, and that the stock is already fully adjusted, even the insider information, into the stock price once the announcements are actually made. I think I'm out of time, aren't I?
Yeah.
So, well, why don't you review, we go watch the dynamic yield curve, maybe do a little research on yield curve dynamics, and then we get back and start getting into the lecture. And I'll do the memo, I'll do the memo. That's that. I'll do this and the memo. Thank you.
Yeah. No, I think it's faster than mine. I was at first I was like overwhelmed and I started kind of like
Do you want me to stop the recording?
yeah.